much for joining us today. I'm excited to hear about a deal analysis you're going to walk through us. But for anyone watching that's in the DMM or on our social media platforms, could you just give a brief introduction about yourself?
Okay, my name is Oleg. I've been with Michael Blank for a while now. Um, just a little bit about myself. So I was born back in the former Soviet Union in one of the Republic, Azerbaijan. Um, moved to the United States around in 1992 with my family, my sister, and my mother. Uh, had a dream of building the American, building the American dream, uh, growing in this country and, becoming a successful person. Went to college. I went to Borough of Manhattan Community College in New York City, get my bachelor degrees and switched to Brooklyn College to get the Bachelor of Science. Um, then graduated from school with a computer science degree in 1998. Worked successfully with several good financial companies. Started with IBM, then moved to JP Morgan, Citibank, Credit Suisse, BNP Paribas. I mean, very, very successful, well-known companies. I've been working with the traders. I was on the trading floor. Very stressful situations,
Yeah,
a
I
lot of
bet.
screaming, a lot of shouting.
Oh no.
So went through that. Sometimes enjoyed it, sometimes not. Um, then we bought our first house, and it turned to be that we did a house hacking without knowing what it is. House hacking, for those of you who don't know, is when you live in one part of the house and rent the other part of the house to other people, and basically they help you pay your mortgage down. So we bought a two-family house back in Brooklyn. We used to live in Brooklyn at that time, renting one part, and me and my mother and my sister lived in the second part. That kind of triggered something in my mind, which I didn't understand. There was a lot of stuff that was new to me. I did not have as much financial knowledge at the time, especially in the housing and the mortgaging. For me, it's very hard to first time learn what's a depreciation and how come I lose the value of my house without losing the value. So that was when I understood what it is. It was a very, very good surprise, and I had really enjoyed that. Um, Later on, I moved. Once I got married, I moved to New Jersey. I start focusing on fix and flip. Did a couple of properties, but understood it's not something for person with 9 to 5 job to do. At the time, it's very time consuming. You have to be on top of the item, on everything. And that's how my focus switched to multifamily. So in 2018, I joined Michael Blank program. Really enjoyed it. I knew what I'm signing up for, and I already started reading a lot about it, about multifamily investing, and I understood that's something I want to focus in my life. I built my company, O&M Property, and start working on my multifamily knowledge and buying the property. So obviously, Michael Blank program helped me a lot. That's why I'm here and I'm learning. I'm trying to help others, but this definitely the programs that does help a lot. So it helped me to jump a lot in my understanding. I had a coach, one-on-one coach that I was uh, learning a lot from, and I was very close even to sign my first deal. I had it under contract, but COVID hit, and kind of made me very upset, right? So I lost a lot of money because I had a deal under contract. I had all the third-party reports to get an agency loan, and as COVID hit, the agency backed off because as a tenant not paying, they're not providing you a loan if your tenant are not paying lower than certain percentage. So at that point, uh, I got very disappointed, but I knew that should not be stopping me. Even so, I lost several thousand of dollars, without gaining anything. Could be very upsetting. But I knew that my goal is, and I kind of continued going over and over, what could be next. And um, fact that I had built a connection with a broker on that deal. The broker came back to me the next year and provided me another deal of market deal that looked good to me, and I did close a deal at that time with the same broker, as he saw my commitment and my integrity, and that was my first deal in 2021. I still hold that deal. We already refinanced the deal, and we returned all the investors' money, and since we all still own it, we right now can basically getting infinite cash flow on the deals that we don't have any money left.
Great. Is that the deal that we're analyzing today, or are we going to be talking about a different deal?
No, we're gonna go about the second deal after that,
Okay.
as I believe that will give more, will teach a little bit more to students in Michael Blank program.
Great. Awesome. Well, I'm excited to see it.
Okay. So this deal, can I share the screen here?
Yes, you can. Perfect. Yep, I can see it.
Okay. So we were actively looking in Midwest. Alabama is where I have my first deal. Louisville is another area where we actively were looking, and I built a lot of networking, property manager, boots on the ground, everything, and we were looking actively in that area. The deal that came across was actually in Indiana, which is across the river from Louisville itself. It's still part of Louisville MSA. The deal was, well, first of all, since it was Indiana, it didn't kind of click for me because it was not part of my market search. But once you start thinking about it, even if it's not the same state, but it's within your area, you should be still looking at it and kind of expand your search criteria, even if it's a different state. So the deal came across as 28 units. The asking price was $4 million. The year it was, the way I organized my SDA, I try to put as much information as possible. So I have the address here, the year it built. If there's any amenities, we would put in here. This property didn't have as many amenities, but if there's like a pool or playground or laundry room, you would put as much possible here. I'm gonna go through the SDA. We fully use target rent analysis. How much is the current rent? How much we're planning to go through. Usually we're looking at least to have 200 units on the rent push. Otherwise, it's really hard, especially nowadays. It's really hard to find the deals that make sense if it's less than that. Looking at the price and asking price, $142,000, made us a little bit scary because we were looking at around 100 units, $100,000 units of purchase price. So when you kind of get those kind of red flag, you think, oh, deal probably not going to make sense, but I'm going to still go through it. We underwrote to 2 years of IO. At this point, we don't have any information about the loan, but doing our best. Not knowing about condition of the property, we put $6,000 per repair. At that time, that was kind of what you needed on the rundown property. Operations, I usually put around $2,000. These numbers are usually should be a little bit lower by other underwriting, but I'll explain why I put more later on. This information I usually marketing package column C3 is what usually in the OM I just copy down to see how does broker evaluate the deal. As you can see, this broker is not lowballing the expenses. You would see normally a broker would put $2,000 in expenses to boost the cap rate for the property. But
Right.
this broker, that's why we love working with him, is he truly underwrites the deal the way it is, the way I would underwrite it. And as we can see, the cap rate comes up to 4.5. At that time, by the way, it was not a bad cap rate. This was July of 2020. 3. Um, my version, I would adjust the other income. Very important to understand is what other income is. Again, this broker does not have as bad other fees. We normally see other fees contain numerous extraordinary amount of money where you would make money, but in reality, it has a lot of late fee, a lot of NDF fee, a lot of fees that you would probably not get if you buy the property, right? Especially if you stabilize the property, you're not going to have all those late fee applied to you, right? I underwrite the property. I would always remove all the late fees. What if my tenant all paid the rent in time, right? You would not incur any late fees on a monthly basis, especially if you change the tenants that you have and bring in the quality tenants. They're not going to pay late, so you're not going to have all those fees. So what we underwrite usually in other income is only whatever you have RUBS, whatever you may have, some pet fees that I can understand you will have, and only the fees like utility fees, only the fees that you're really confident you will probably get. That cuts down a lot of deals from us, I agree, but that removes a lot of surprises.
Right. Yeah.
Advertising fee, we usually, put around $50. Contract services, they didn't have anything. We were planning to have our low, after talking to our property manager, landscaping services, etc., and some kind of pest control. This is, as you can see, I always put some kind of a notes of why am I doing this or that in the SDA. So if somebody looks at it, I have a couple of partners on the deal, and we underwrite a lot of deals on a weekly basis, not only on a monthly. And you always would forget why did you change this? So putting the notes to be able to explain it would be very useful. Real estate taxes, this is what we calculated it should go to. Very often, this is overlooked. Uh, Indiana is not really such a bad state where the taxes would jump, but there's some states where the taxes would double on you. South Carolina is one of the states where we're looking right now, and if you don't double your taxes after purchase, you're probably going to lose money on the deal. What also we felt the trash is a little bit underwritten, so we increased it a little bit, but actually, as you can see later on, we reduced it back as we got a good quote. So we underwrite, was the way I do it, I underwrite my version here, and even so the projected are also increased, we go by offer, by column, version C. And the way we do it, we see what the current rent roll is, and we adjust it to exactly the amount that's the gross income right now. So this way we adjust the vacancy and the concession. These numbers were finalized later on by property manager. He told us to reduce advertising since the advertising there could be done at 1,200. He asked us to increase the contract services, and most of the other numbers stayed the same, right? He gave us very low number on repair and maintenance and turnover, but that's because he said the property is in a fairly good condition. So after underwriting all this, we came up with a price of 3.7, right? We went back actually to the seller and offered them 3.6 on this property to have a little bit wiggle room for our negotiation. And as you can see, if I move back to summary, the property is doing really well, 7%, 21% ARR, 7% cash and cash. We're doing very good. The property would cash flow very well, would have been a very good investment for our investors as well. Again, we pushed the rents here to 1,300, what we believe would be good year two rent. We also added, as you can see, again, as you highlight or change something, you need to put the notes. And the notes here, we will introduce RUBS, which is currently not being taken for the property, and this was a talk to our property manager and confirmed by them that that's something we can do. Exit strategy, we try not to underwrite refinance. I know refinance usually boost up your returns, but we take worst possible case. If we keep it without refinance, and if it works, we know we can refinance later on if we need to. And returns looks very good. As you can see, cash and cash return of year one would have been 6%, which is excellent, without
Yeah,
for any property. In the year three, it will go a little bit down because our IO ends, but we still hold on average very good cash flow. It stays around 7%.
that's
So
great.
at this point, the deal looked wonderful. Again, this was an our offer price. After we went to the broker, and some negotiation back and forth with the broker and the seller, we agreed on a price of 3.8. And I'm gonna open the next SDA. It's a little bit later on, and this came in as we start looking at the loan, doing more due diligence. Actually, our first loan quote we got from our lender. We use Dunlop on VOC. They came up with 4.6. So that was a very great rate at the time. Nowadays, you cannot even dream about those rates. 4.6 was wonderful. We would cash flow even more than what I showed you before. At that time, cash and cash would have jumped to 9%, and the ARR would be nearly 19%. And it was a step down loan, which is for those of you who don't know, we have two type of loans: step down and yield maintenance. Step down is the naming of the loan connects to the fee, and the step down would be as you hold the loan longer and longer, your penalty for paying off the loan would have been less and less. On the yield maintenance, actually, you pay a certain percent of fee if you pay off the loan faster. So if you take a loan for 7 years, you have to hold it for 7 years, or you have to pay a certain big percentage of a loan, big percentage of a fee, basically. On the on the step down, first year, if you pay it off, it's high, but then as you hold the loan longer and longer, it goes down to maybe 1% or 2%. And that's something you would get the information from your lender. Basically, step down is an ideal loan to go with. You have more flexibility. As we agree on the price of 3.8, we start working on getting the PSA signed. We reached out to our insurance broker to get the quote. We once again went over all the expenses with a property manager. There's a few adjustments. We called the assessor's office, got the taxes nailed down, and basically doing as much due diligence as possible. As we start, as our attorneys start going back and forth, our attorney and the seller attorney going back and forth, we noticed that the rate's starting to change. At that time, the rates already jumped to 5%, which kind of worried us a little bit. But we still were confident the deal looked very good. We hired an inspection company who inspected each unit. Well, we flew out to Indiana, of course, with the whole team. It's me and another two partners of mine. All three of us. Well, one of them is here in New Jersey as well, where I live. The other one is from Florida. All three of us flew to Indiana. We worked with the inspection company, all the units of the property, got a fully detailed report, and we were kind of going through the due diligence documentations that provided by the seller. We were waiting on a third-party report from the lender, and we were waiting for the agency to approve our loan. Everything looked good. But those of you who've been in real estate for some time know that at that time in the summer the rates were going up. It was as low as maybe 3.5%. You could have closed the loan at 3.5%. to what right now is around 6 to 7%, depending on the type of loan you're looking. So
Right.
by the time that happened, our loan from 5% changed to 5.33. So, as you can see from original underwriting of 4.6, it changed to 5.33. And the deal didn't look as good. We had to make some adjustments. We had to increase the preferred return a little bit to boost up the return for investor. We really wanted to make sure that they're getting doubling their money in 5 years. Cash and cash is strong. Again, we had to reduce our rate a little bit, and we reduced our asset management as well. But the deal still looked very, very, very good for us, and the returns were very good as well. But as the longer we waited for agency loan to get approved, the rate was climbing higher and higher and higher. And I'm going to give you share the latest version of SDA, where the rate was already at 563 by the time we closed, and that was pre-lock. That's where we were about to lock the rate. The deal did not look already as nice as we were hoping. The average annual return went down to almost 15%. Cash and cash really looks still good because the property was cash flowing very strongly, and we had a preferred return. It's very important to notice in these cases that you don't have a lot of money in deficiency. We were seeing that year one we were in deficient, but we knew that we're going to pay that money back to our investor at that time. So we were not really concerned about that. And it's not a very big amount, only 17,000. So what that usually means, we as managers don't get paid at that time, right? But at least the investors we know in a good shape. And we were really panicking. I mean, this was my third or fourth deal at that time. So I don't really have 100 properties under my belt to be very confident. So I was very nervous. It's not a joke that we already had the investors committed and bringing the money, and we promised them. We did the presentation. We showed them the investment presentation, how much return we're planning to give them. And as we're trying to close a property, the rates are going up and up and up, and we don't even have a chance to commit it, to lock it at that time. I mean, it's already been 5:33. We were very, very nervous. We didn't know what to do. I mean, we knew we had to close it because we already committed a lot of money, but we had to make sure that it has not gone through the point where it's too late and we had to back off. So at that point, right before we closed, I'm going to show you the final SDAs that we already put in later on. The closing rate was 5.7. So basically the rent changed from us more than 1 point, from 4.6 to 5.7 almost. We had to do a lot of adjustments again. We had to reduce our acquisition fee. We probably would have done it even less if we could, if we needed to. Basically, cash and cash was still strong. We had to remove preferred return. We had to change the deal structure. Of course, we gave more member equity to the investors. After talking to investors and explaining them what happened, we wanted to find out what's more important to them, to double their money, or they would prefer the cash flow to be stronger. And most of the people almost all of them who invested in this deal said that they would prefer to have a strong cash flow rather than focusing on doubling their money in 5 years. So that was our focus. That's why we kept the cash flow very strong. And if you look at the returns, first year is still cash flowing at 5%, which is very strong for any property. If I get a property at cash flow year one at 5%, I'll always take it. And average return goes to 6 and then eventually to 7 to this property. What else very interesting? We closed about it. It was very important to talk to investors all the time, explain to them what's happening, as we nearly talk to them almost every other day, explaining that the rates are changing, the deals are changing. this is how it's going to look. We have to remove the preferred return. While we're doing that, what's the impact on you? How do you prefer? Would you be still be interested in this deal on that, based on this criteria or not? Uh, but that's where we end up. We had to switch the loan to, even so it was 5.6, 5.69. We had to change it from step down to yield maintenance. But and we still kept it for 5 years, basically. Um, and we at this point we closed the loan, and we were able to close it successfully without any problems. Unfortunately, that didn't end the problems with this deal. 5 months down the road, we had to change our property manager. Even so, the property manager we had was very good. I can't say they were not a bad property management company, but it didn't fit the way they were not handling the property or communicating to us the way we wanted, the way we talked about.
Yeah.
The bigger property manager, but we prefer to have like a one or two person we talk to all the time instead of being sent to a different people to get the information. So 5 months, 6 months down the road, we had to change a property management company, which really cost us a little bit more than we underwritten. But first of all, they were much better company. They saved us a little bit more on the expenses.
Oh, good.
They did much, our expenses reduced. I mean, we didn't know that at the time, but they did, helped us with that. They're much more robust of filling the units, bringing the rents to the market. And In fact, we're using the same property managers on two other properties we bought in Indiana later on in the year. Last year and last year and year after. I
That's great. I'm
mentioned,
glad that you found someone that you could use for their properties.
yeah, I mean, we were really surprised. We had that another big challenge with this property. We There was a new property built maybe in our city, brand new Class A property, and the rent normal in the Class A property much higher, but they needed to fill the units much faster, so they reduced the rent, and their rent was competing with ours at that time. Nevertheless, our property managers were able to help us to fill the units at the quality tenants and keep us not a high vacancy. So right now, the property cash flowing very well for us. We are a little bit ahead of our projections. We did the cost segregation to help our investors to save more money, write off the money. So this was an interesting deal. A lot of challenges on it, and a lot of learning point. I mean, one of my partner was somebody I was teaching. It's kind of a mentor. He's not, so I had to go through everything, explain to him. So for him, it was kind of a crazy deal. He said, "Oleg, is all your deals crazy like that?" I said, "No, you're the lucky one to get the first one like this." But this deal taught me a lot. You need to underwrite super, super conservative. Conservative. As you can see, our underwriting was so good that we were able. So our rate was increased more than a point, and we were still able to close the deal. Normally, rate doesn't go that much up. Half a point would have been the most probably, but as I speaking to people who invest in real estate for years, they're telling me that's not normal that the rate jumped so much in such a quick period of time. So conservative underwriting is number one key.
That's a
We
great
worked with
takeaway. Everyone write that down.
Yeah, definitely. I mean, I see a lot of people underwriting very thinly deals. They don't have a lot of buffer on the deal. It's better to underwrite with a buffer. And if you have to pass on a deal, pass on a deal. I would rather do that than commit to the deal, spend some money, and then back off and not only lose money, but you're also going to be having a kind of a bad taste in your mouth, so to speak. Um, what else? We worked with a seller. Seller actually came back and says, we asked him if it's possible for him to give us some credit since the rate changed so much on us. He wasn't much, but he gave us a little bit of a credit. As he said, I understand where you are. He is an experienced real estate investor. So he said, I understand what's happening, how crazy you guys are. So I don't mind giving you a little bit of credit. Um, we communicated with our investors, almost on a daily basis, explaining what's happening. As they were calling us and asking us, we see here on the news that the rate is rising up. How is that impacting us? We have to explain, and we have to send a newsletter, not newsletter, on almost a daily basis to them what's happening and what's changing on it. How is that going to look? What's the impact for them? So communication is very important. B, in this deal, I explained to you, we had to cut our fees a lot. And notice in SDA, we don't have acquisition on this deal. We're basically managing this deal for free. I mean, sometimes you have to do that to make the deal work. You have to kind of give up some of your fees. We still have capital transaction fee left, but acquisition, so we're not getting paid for the job we're doing on a daily basis right now. We cut our acquisition fee was 3%. We cut it to 2.5%. I think I mentioned that. Uh, what else? What else I would say about this deal? After talking to the same broker, after the broker working with this broker on this deal and how he saw that we're trying to very hard to close this deal even through what's happening, he was able to bring us another deal that, as I mentioned, one of the two deals we closed later on was with the same exact broker. So working with a broker and showing how committed you are to the deal, how professional you are, always pays off. You never know when, but it will pay off. And in this case, it paid off sooner. But brokers remember this kind of stuff, and he's still bringing us a lot of off-market deals that we work. Some of them we're close, some of them are not. But it's always good to build a relationship like this. So there's a lot of positive I learned from this deal for myself and for my team, I think.
Yeah, definitely. And for anyone watching this too, feel free to comment your questions for Oleg, and we'll make sure to tag him. One really great thing about the people in our community, especially Oleg, is they want to help the other people in the Michael Blanc community learn. He's so down to help anyone answer any questions. I know when we do a lot of these deal analysis, some people, they might come through and have a specific question that only applies to this particular deal. So being able to message and talk to you is great. So feel free to comment any questions that you guys have for Oleg.
Yeah, if you tag me as you put the comment in, I usually very good with checking my messages, and I'll be happy to answer. If there's any questions about this deal or in general, if I can, I'll be happy to answer about SDA or any other information.
Great. Great. Awesome. Well, thank you so much for taking the time to go through this deal. That's super helpful to see those numbers. I'm glad that it worked out, and it sounds like it was a learning experience, but a very positive one for you. So thank you
Yes.
again. Thanks everyone for watching. We'll see you guys soon.